Welcome back to the Daily Crypto Roundup. Today's session comes at a moment of renewed momentum across crypto markets, with prices breaking out sharply in the last few hours, as traders responded to a cluster of macro developments and policy surprises. Bitcoin, which had been holding just above the $90,000 level for much of the morning, suddenly climbed more than $2,000 in under an hour, briefly trading near $92,000 as broader sentiment shifted. This rapid move reflected both technical positioning and short-term responses to macro headlines, creating a surge in activity that caught many market participants off guard. Ethereum similarly lifted alongside Bitcoin in this intraday move, and while broader markets remain cautious, the recent uptick in price action signals that liquidity is returning and sentiment is reacting to real-time catalysts rather than lingering in indecision. That said, it's important to differentiate between a short-term burst of buying and a sustained trend change. Today's move was sharp, quick, and tied directly to evolving macro and regulatory news flow, something we'll unpack in detail as we go through today's top stories. One of the most widely discussed questions today has been a simple one. Why has crypto been moving the way it has, despite a lack of dramatic headlines? The consensus among analysts is that this is not a narrative-driven market at the moment. Instead, price behavior appears to be dominated by positioning, derivatives flows, and macro timing, rather than long-term conviction changes. This is important because it suggests that what we are seeing is not distribution or capitulation, but recalibration. Much of today's movement has been attributed to traders adjusting exposure ahead of key macro events. U.S. employment data remains a major focal point, with markets trying to anticipate what it might imply for interest rates, liquidity conditions, and risk appetite more broadly. At the same time, a pending Supreme Court decision on global tariff policy is adding another layer of uncertainty, particularly for markets sensitive to international trade and capital flows. In that context, crypto is behaving less like an isolated asset class and more like a component of the broader risk complex. This is something that has become increasingly clear over the past cycle. Digital assets are no longer trading purely on internal narratives. They are responding to the same macro forces that drive equities, commodities, and currencies, even if the reactions are sometimes amplified. Alongside macro pressure, derivatives markets are playing a major role today. A large batch of Bitcoin and Ethereum options is expiring, and this has introduced short-term gravitational forces around certain price levels. Traders familiar with options dynamics will recognize this pattern. As expiry approaches, spot prices often drift toward so-called max pain zones, where the greatest number of contracts expire worthless. This doesn't reflect a view on long-term value. It reflects mechanics. Once these expiries pass, markets often regain freedom to move more decisively. That is why many analysts are cautioning against over-interpreting today's price behavior. It is being shaped by timing and structure, not by a sudden shift in belief. While markets hesitate, policymakers are not. One of the most consequential stories today comes out of the United States Senate, where lawmakers are moving toward dueling markups on major crypto market structure legislation. This is a critical development. For years, the industry has complained about regulatory uncertainty, enforcement-first approaches, and the lack of clear jurisdictional boundaries. What we are now seeing is the early stage of an attempt to formalize how crypto markets are regulated at the federal level. The fact that multiple committees are involved highlights both the importance and the complexity of the issue. Digital assets touch banking, commodities, securities, payments, and consumer protection. Bringing clarity to that intersection will not be quick or simple, but the direction of travel is becoming clearer. The U.S. is no longer debating whether crypto should be regulated. It is debating how. That distinction matters. Markets tend to fear uncertainty more than regulation itself. Clear rules, even if strict, allow institutions to operate with confidence. They allow capital to plan, deploy, and scale. Today's developments suggest that the U.S. legislative process is slowly moving from hostility and confusion toward engagement and structure. This shift is mirrored internationally. In South Korea, reports today indicate that regulators are preparing to reverse their long-standing opposition to spot Bitcoin exchange-traded funds. This would represent a significant policy change in one of the world's most active retail crypto markets. South Korea has historically taken a cautious stance toward crypto financial products, particularly those accessible to the general public. A move toward permitting spot ETFs would signal growing comfort with crypto as a mainstream financial asset rather than a fringe speculative instrument. It would also align South Korea more closely with other major jurisdictions that have already approved similar products. Importantly, it suggests that global regulatory convergence may be accelerating, even if timelines and details differ from country to country. The international dimension continues in the UK, where today saw confirmation of Ripple Markets UK Limited regulatory approval involving a high-profile crypto firm. Approval by the Financial Conduct Authority is not symbolic. It requires rigorous compliance with anti-money laundering standards, governance requirements, and operational transparency. For the UK, this is part of a broader strategy to position itself as a regulated, credible hub for digital asset activity, rather than allowing the sector to operate in legal gray zones. Taken together, developments in the US, South Korea, and the UK point toward a common theme. Crypto is being absorbed into the global financial system rather than excluded from it. This process is messy, uneven, and often contentious, but it is underway. Institutional behavior reinforces this interpretation. One of the most striking stories today involves Tether, the issuer of the largest stablecoin in the world, reportedly investing up to $50 million into a crypto lending platform at a valuation of around $500 million. This is notable not just because of the size of the investment, but because of who is making it. Tether has traditionally been viewed primarily as an infrastructure provider, supplying liquidity to markets via its stablecoin. Increasingly, however, it is behaving like a strategic investor. By allocating capital directly into crypto financial services firms, Tether is positioning itself as an active participant in shaping the ecosystem rather than a passive utility. This move also speaks to confidence in the crypto credit market at a time when traditional lending conditions remain tight. Following the collapses and deleveraging events of previous years, the crypto lending space has been forced to clean itself up. Surviving firms are operating with more conservative risk management, stronger collateral requirements, and greater transparency. Capital flowing into that space today suggests that at least some institutional players believe the worst excesses are behind us. It does not mean risk has disappeared, but it does suggest that crypto finance is entering a more mature phase. That maturity theme is echoed in commentary from leading venture capital firms. Today, Andreessen Horowitz published analysis arguing that the next phase of crypto innovation will extend beyond simply launching new blockchains. According to their view, the focus is shifting toward applications, user experience, and real-world integration, rather than raw protocol proliferation. This perspective aligns with what many developers have been saying quietly for some time. Infrastructure is no longer the bottleneck. Adoption is. The challenge now is not building faster chains, but building products people actually use, trust, and understand. That includes payments, identity, data, and coordination tools that solve real problems, rather than existing solely for speculative purposes. From an investment standpoint, this represents a potential pivot point. Markets that have spent years rewarding novelty and experimentation may begin to reward execution and utility instead. That transition is rarely smooth, but it often marks the difference between speculative cycles and sustainable growth. All of this is unfolding against a backdrop of heightened macro sensitivity. Bitcoin, often described as a hedge against traditional finance, is increasingly reacting to the same data points that move equities and bonds. Today's focus on US jobs data and trade policy reflects that integration. Some see this as a loss of crypto's independence. Others see it as validation. Assets that matter are assets that are watched, traded, and reacted to by global capital. Crypto is now firmly in that category. The question markets are grappling with is timing. Regulatory clarity is coming, but not instantly. Institutional adoption is growing, but unevenly. Macroeconomic conditions are restrictive, but potentially nearing an inflection point. In that environment, patience becomes a strategy rather than a weakness. What today's stories collectively suggest is that crypto is in a transitional phase. The easy narratives are gone. The Wild West is being fenced in. The industry is being forced to grow up in public, under scrutiny, and within the constraints of existing financial systems. That process creates friction, but it also creates opportunity. Markets that survive regulation, integration, and institutionalization tend to emerge stronger, more resilient, and more durable. As we head into the next session, the key things to watch are not individual price ticks, but confirmation signals. Does legislative momentum continue? Do regulators follow through? Does institutional capital keep engaging despite short-term volatility? And does macro data provide enough clarity for risk appetite to return? Those answers will shape the next move far more than today's noise. Before we wrap up, a quick note on today's XRP giveaway. Congratulations to Andre Legel, who'll be receiving 10 XRP, and Kay Chamberlain, who'll be getting 5 XRP. Thanks to everyone who took part, left comments, and supported the show. We'll be running more XRP giveaways very soon, so keep listening and stay involved. Drop your thoughts in the comments, smash like, follow for the next update, and as always, we will see you at the top.